All right, what a week. That was quite a big session on Thursday. Sometimes I like to use the framing of tectonic plates shifting. That was one of the weeks that we just had. Now, I've had yellow on stocks after the move from yesterday. I'm not changing it yet because this regime that we're dabbling with now, we've only had 2 days of it, and they were quite a bit mixed. And if it's going to look like what we got on Thursday, the math is not good, or at least as good for the market as what we had before in the tech AI-driven regime. I've said for months now that that's the most desirable outcome, the secular boom of AI that was able to distract us from the weakening in the economy, give us a reason to buy the most important companies, good reason. But now this week, the market wants to make big bets on the economy. That, I think, starts to get risky. Everything else here looking great, I think, on my risk radar. Red and crypto, just what a mess. Can't catch a bid for anything. Basically faded again today. Bonds green. I held that through a bit of a storm, and bond buyers did indeed come back. One way to look at this week, and the newfound optimism on the outlook for the economy can be seen just simply in the inflation surprise rate going negative for the first time in a while. That's really important. Keep in mind, we had spent all year, the white line here is the city inflation surprise index. We were in positive territory. Inflation was beating expectations. Now with the CPI miss and a few others that have come in soft, we go into negative territory. That's what you want. But here's the issue and why I've been hesitant to get bullish on the concept of rotation. Bullish on AI leadership? Heck yeah. Rotation, much riskier, because while our inflation data are now coming back down and missing, that's good. One, they're still too high for the Fed to cut. It's not going to happen in July. Maybe he'll set the plate in August, but we're not going to get information from Powell that says he's going to cut until August. And at the same time, the economic surprise rate is still in the basement. That's not a good trade-off. I've always argued you should root for inflation and growth. What you don't want is growth to slow while inflation at a nominal level is still high. Even though inflation is slowing, we're missing so much more data along the way. That's why inflation's now slowing down, because the consumer's losing a lot of their power. It's just a fact. Now, we're also coming off good nominal levels for the overall data, but this is a really negative surprise rate, and that's where still the trade-off. The market this week was pricing like an immaculate landing. That's really tough to pull off. In history, it's actually when the Fed does start to cut that's when things really do slow down, because it is the landing. We have been soft landing. We've been soft landing for 9 months. That's the point. Our wheels might actually be touching the ground here, and the market, I think, might be confusing that degree of safety with something else, which is that we could really have slowdown from here. Maybe inflation goes with it too. But that's the risk, and that's where everything's got to go perfectly. So it's not a reason to try and fade stocks in the move. It's not. What's actually still more important is the fact that the S&P math doesn't add up in rotation without big tech. If it's going to go like it did on Thursday, which looked like we had to take money from tech to buy the other stuff, that math doesn't add up. And so we had that big bearish engulfing candle, and today's didn't offer a lot of respite. The fact that we faded into the close, if we had ramped back up, then that would have been great. But what it means is that we've only had 2 days in this new regime. And believe me, it's a new regime. When you get the Russell and the equal weight waking up like they did after just months, basically years really, a 3-year high for the Russell. Okay, that's a big, big move. That means the expectations have shifted way higher for everything cyclical, everything connected to the economy for earnings. We've got to hit all the cyclical earnings on point. And what we've already heard from some of the banks is that there is a little bit of weakness still building. We've seen that because we've watched the unemployment numbers go up and all that economic data missing expectations. Rotation game is a riskier game than AI. It doesn't have to be negative, but it's going to be a difficult thing to chew through, and we don't have enough evidence yet. The fact that we faded the tech stuff, I'll hold the yellow light for now. Everything else seems to be in good place, so I'm confident on my general framework. If we do get more participation like we got today and we start putting in the highs again for the tech stuff too, then beautiful. We got everything we ever wanted, but we still don't have enough information to say that with some certainty. It was a really fun week. Have a great weekend.